Hi, I'm Llanes with Wealthnet Investments. Today I want to talk a little bit about the so-called market turmoil. It definitely feels like a turmoil. And the reason why is because we saw one of the most rapid declines that we've ever seen in market history. Rapid meaning we had a fast decline from the highs of over 12%. We basically went up to the highs. We had a nice rally recently, and then we came off by 12% very, very, very quickly. So for that reason, that's getting people a little bit nervous, a lot nervous. And of course, the coronavirus is the primary culprit or problem that we're seeing. Now, when I look at kind of what the data is showing, and I just keep going through and analyzing this, this rapid decline, we could say that it is somewhat fundamental because there is some supply chain issues that are occurring. We are seeing companies like MasterCard saying that they are definitely going to have to make some adjustments to volumes. We also are seeing a fear-based change in consumer behavior, which will affect sales most likely in some companies. So you can't just say it's just all emotional. There's definitely a fundamental element to this. And I think anytime there's a lot of uncertainty, that gets the markets very obviously in sell mode, especially after we've had a very large rise. So I think if you're a client of ours, one thing that you need to understand is that we already have a lot of dry powder. We've been conservative. We've actually started lightening up and being conservative going into this decline. So our portfolios are holding up very well. In fact, if you look at the firm-wide asset allocation, we're sitting at, there's about 42% of our assets are in defensive types of securities, cash, bonds, gold. We added a tactical position a while back that allowed us to get into gold more and into the long bond and into real estate issues, which has really helped prop up the portfolio. And also in our fundamental core element and how we manage stocks, we have an emphasis on quality and valuation. So we made a rebalance where we bought more quality. We upgraded the quality of our portfolio and upgraded the valuation of our portfolio. So right now we're sitting about 44.38% in U.S. stocks globally across all of our clients. And about 14% in international stocks. We don't have huge exposures to China. We have some, but we don't have huge exposures. We've had some discussion about lightening up. We have done some lightening up as well there. We'll probably do some more there. But I wanted to actually make a point about how if you're an index investor, you're really getting hurt in this type of environment. And this is something we've talked a lot about because the stocks that are huge in the index, that have a huge weighting in the index, those are the stocks that are sources of funds where institutional investors are hitting the sell button and raising cash. And so that directly hurts index investors because those indexes are market cap weighted. So that's one thing that I really want to talk about. So we're coming into this thing already positioned with a lot of dry powder. And we saw a lot of more aggressive strategies. We saw a lot of stocks line up to buy points, and many of those stocks took off pretty rapidly. And we took profits. We've been taking profits on those, and some of those have stopped out in losses. But what we're seeing in our aggressive strategy is that we are seeing our market regime indicators have told us to be very careful and pare back on any new buy entries. So we have been more conservative on buy entries, very selective. We just added a position in Zoom that was up, when I saw earlier, was up 5% today. I don't know how it landed the rest of the day. But, in a down day, we had a 4% down day today in the stock market, a very rapid decline. So, and it's funny because some clients have called in and say, hey, I hope you're doing okay. And, we really don't stress out at Wealthnet about these things because we're very diversified and because we have a strategy to deal with these things. And our objective is to have smooth rides for our clients as much as possible. So again, we're coming in at 42% of portfolios on average for all clients across the board with conservative positioning. If you look at our equity regions, like what, looking at this is a global phenomenon we're looking at. So if you look at how we're positioned, globally, we have about 6% of the portfolio in Greater Asia. So only about 6.17% of the portfolio is in Greater Asia. Most of our assets right now are in North American high-quality U.S. stocks, 77% of the total equity exposure, which is about 44% of total exposures. We have very little exposure in Europe. In Greater Europe, we're at 3.64%, and just minuscule amounts in Latin America. We're really not putting a lot of emphasis there. Japan, we have about 4% in Japan in that Greater Asia positioning, and the rest of it, a lot of that's the rest is in China. So it's still a relatively small amount. If you look at in terms of the style, like you think of value and growth, large, mid, small, most of our assets are in large cap companies. We have a value tilt, high quality value tilt. Only about 15% of our equity exposures are in kind of high, what you would consider more expensive type stocks. The rest is in more blend value type. If you're looking at style boxes, we're not a huge style box fan, but there's some people that kind of want to know these things to get a feel. Most of what we're doing is in the large cap area. Right now, we've been, as we've been more quality oriented, we've been more in the large cap area. So in terms of our sectors, we're balanced across the board. Basic materials, we have about 6.61%, consumer cyclicals 8.62%, financial services 12.82%. Our biggest exposures, we have quite a bit in healthcare right now. And this is one thing that we are watching is kind of what I call the contingency Bernie Sanders trade. There are, in the unlikely smaller per probability that Bernie Sanders is voted in as our new president, that would definitely change the landscape in the healthcare area. So, and in fact, in this last decline, we saw accelerations to the downside in healthcare names. So, and there's a lot of value in that group, but that value may not be recognized if we have some kind of a regulatory situation that changes the landscape a lot. As for real estate, we've upped our real estate exposure in our tactical allocation because many of these real estate companies have more solid cash flows that should do well in a decline. And with this drop in interest rate, we saw some pretty significant pops, even in smaller cap, more dynamic companies like Redfin, which we traded into and saw a really nice 20 plus gain in a very short period of time. So that's what we're looking at. A consumer defensive, those consumer defensive stocks are pretty expensive, but we do have some exposure there, 8.73%. One of the big things that I want to point out is that if you look at how we're investing, you look at the metrics of the types of companies that we're investing in. If you look at the growth measures, our average holdings, the dividend yield's 2.25% on average in our portfolios. Plus, we're seeing our holdings have historical growth rates of about 12.96%. That's what they've been showing historically. And the sales growth, 6.89%, which is higher than the sales growth in the market. Yet we're able to get the valuations in line or better than the market. So that's really what we're trying to do is get better valuation, higher quality for our dollar with better growth expectations, just where there's some mismatch in the market and to diversify. And we think that's going to serve us well, with expectations of growth. The book value has been growing at 6.74. And these are good numbers for the fundamentals. It's funny because I was looking at the numbers of companies that have reported. Something like 70% of all the companies have reported earnings so far, and many of those companies have missed on the revenue line. There's been quite a few beats, but on the bottom line, but those numbers have not been as much of a beat as it has been in the past, if that makes sense. So the rate of acceleration has slowed. So we've seen some of that. We're probably going to see some more of that. Given the momentum to the downside, I would expect that we would have a little bit more to the downside. But we're positioned right now well, and we're looking to actually look at opportunities. Right now, I mean, we're always looking at our watch list. We're always looking at where can we find better opportunity. So this is where we're at in the marketplace. So being disciplined as an investor, we can smile when we have these kind of declines because we don't want to be that investor who is chasing all the time. We have a sell discipline. Even in those positions, those strategies that we have that are more momentum oriented, where we're buying breakouts and they're moving higher, we have very strong sell disciplines, and we'll stop out of those and we'll get out of those if they're not working. In the longer term fundamental core value oriented type strategies, it's definitely a smaller position size, longer term type of plays. And I think when you blend these types of strategies together, you get a better performance. And so investors should not be that nervous and scared right now. If you are, it's possible that maybe your risk tolerance is lower than how you have been investing, and maybe you've been looking at past historical numbers. And we see this all the time, where people will be looking at like past historical numbers and say, okay, that's a good one, let's buy that. And it actually worked for several years. Now, this has happened in the dot-com bubble. This has happened several times in my career when people if they just look at the biggest numbers on their list on their 401k in terms of return, and they buy it and then it works for a while, they think they're geniuses, right? And I don't need a strategy. That is my strategy. Very poor strategy in the long run. It's better to have, momentum is fine, but you have to make sure you're using intermediate term momentum and that you have risk management rules, diversification rules. Anyhow, so that's my message for today. So what my thought is on this, and JP Tremblay, is our Chief Investment Officer, and myself have been discussing this. Our thought is that maybe lowering more exposures from here in the international might make some sense still from where we are. We're also thinking that potentially there's going to be some good setups that are going to happen here. And fear has started to settle in. And when that happens, I smell opportunity. So this is Louis Llanes with Wealthnet Investments. Just signing off for now. Hope you guys are having a great day. We're doing fine over here. I hope you're doing fine. If you guys have any questions, you want to talk about your investments, you want to talk about your planning, give us a call. Have a great day.